everyone, welcome to Dezan Shira Associates podcast series. As a specialist practice providing foreign direct investment consulting services for international business, we are here to share the latest business information of Asian market, wishing to give you more idea on doing business in Asia. So please keep following us in our website at www.dezanshira.com or our subsidiary Publishing Asia Briefing website at www.asiabriefing.com for more business news and information. In one of our previous podcasts, we discussed about how to establish a representative office as the first step into China. However, due to various reasons, foreign investors may find it useful to set up a wholly foreign-owned enterprise, which is also known as WFOE, which is a 100% foreign-owned limited liability company to further develop their business in China. Today, we are happy to invite Isabelle Ding to discuss with us about how to convert from your RO to a WFOE with minimum interruptions to your day-to-day operations. Hi, Isabelle. Please say hello to everyone.
Hello, Cindy. Hello, everyone. I'm Isabelle Ding from Dezan Shira's International Business Advisory Team based in Shanghai. It's my pleasure to be here.
Thanks for coming today, Isabelle. Can you please firstly introduce us what are the common incentives for investors to convert from RO to WFOE?
Sure. Foreign investors may want to convert their existing RO to a WFOE for a variety of reasons. Notably, as the business operations in China begin to grow and expand, investors may find a RO no longer serving their interests very well due to its various limitations. For example, a typical RO has limited business scope and is not allowed to engage in profit-making activities such as import, export, and trading. It cannot issue tax invoices to customers, nor it can hire local employees directly. In many cases, these limitations of the RO seriously constrain the business's ability to expand. Imagine your RO is successful in finding a customer who has demonstrated interest in buying your products or services in large quantity. However, the customer requires to make payment in local currency and also to be issued with the fapiao, which is the Chinese tax invoice. As such, practices are very common in China, especially among companies which are large and prestigious. Not being able to issue the fapiao means you will probably lose the potential lucrative business deals. A WFOE, on the other hand, is not subject to all of the above constraints. Another common reason which drives foreign investors to convert a RO to a WFOE is due to tax considerations. As you know, our RO is taxed at 11.75% flat rate on expenses. Therefore, as the RO's expense increases, the tax bill of the RO would also increase significantly. Once RO's expenses reach certain threshold, it may be the case that operating a WFOE would actually be more tax efficient than operating a RO, in the sense that a WFOE can more easily manage its revenue and expenses to limit its tax burden, whereas our RO is inflexible in this regard.
That is great. But can you please also share some of the important issues that foreign investors need to be aware of when attempting to convert RO to WFOE in China?
First of all, there is no direct conversion between RO to WFOE in China. Conversion from RO to WFOE actually involves setting up a WFOE first and then deregister the RO later. Both are relatively lengthy and time-consuming processes, which takes at least several months to complete. Second, timing is really important for the smooth operational transition between RO to WFOE. As employees will need to be transferred to the new WFOE before the RO is deregistered, investors will need to plan ahead regarding when the process of employee transfer should start relative to the other operational aspects in order to minimize employment-related risk as well as interruptions to the day-to-day running of the business. Third, as tax clearance is required to close the RO, any tax incompliances during the course of the RO may mean a surprise tax bill, highlighting the need for a pre-closure financial and tax review for the purpose of mitigating unexpected liabilities. Lastly, while a WFOE would be more rewarding from a commercial perspective, a WFOE's operational aspects, such as accounting, banking, human resource management, may be more complicated and resource-intensive as compared to the RO.
So, at what stage do you suggest the investors need to transfer their employees, since the timing is so important?
Employee transfer usually takes place during WFOE's post-licensing stage, perhaps just after WFOE has obtained its bank accounts, and with reasonable assurance of receiving capital injection within 1 month. Earlier than that, although it is theoretically possible to transfer employees after obtaining the business license and company chops, however, the WFOE may not have the money to pay for the employee salary yet. On the other hand, if employees are to be transferred later, then it may delay the RO deregistration process, which could mean extra cost in terms of monthly tax compliance and bookkeeping.
Okay, I see. Except from the timing, can you please also introduce the process of employee transfer details to us? I believe investors care a lot about the detailed process of transfer.
First of all, investors would need to identify the core employees and the non-core employees currently employed by the RO and decide who will be retained and who will not. Next, investors will need to review the staffing agreement between RO and FESCO. FESCO is a government-backed HR agency responsible for hiring employees and second them to work for the RO. The staffing agreement will need to be reviewed thoroughly in order to identify potential liabilities during the termination of staff and the closure of the RO. After reviewing the agreements, investors will need to communicate with core employees in advance and reach bilateral agreements on resigning from FESCO and signing new employment contract with the new WFOE. Once agreement is reached, investors would go on discussing with FESCO on how to either terminate or transfer the employees to the new WFOE, and if severance is involved, then how much would need to be paid. Once employees terminated their employment relations with FESCO, they could sign new employment contract and begin to work at the WFOE almost immediately. However, investors would need to be aware that according to China employment law, a written employment contract has to be signed with employees within 1 month, starting from the first day employees begin to work at the WFOE. Otherwise, employers could be liable for paying double salary payment for each month employees are working without a contract for up to 11 months. Finally, the employer would need to complete other related HR administration issues such as having employees to read and sign employment handbooks, establishing corporate social insurance account and housing fund accounts, affiliating employees' social insurance and housing fund accounts under the company's account, as well as transfer the Dezan, which are the personal files of the employees, to the WFOE's account.
It seems to be a very complicated process, doesn't it?
Yes, it is. This is why many clients come to Dezan, Shira and Associates wishing to get professional assistance when transitioning from the RO to the WFOE.
Cool. At the end of today's talk, can you please share some of the risks foreign investors may face when converting from RO to WFOE?
Sure. During the WFOE's establishment phase, depending on the business scope of the WFOE, additional license or approval may be required, which will prolong the WFOE setup process. After WFOE is being set up, it is expected to engage in bookkeeping and tax compliance within a short period of time, and failing to do so may result in penalties imposed by the tax bureau. During the employee transfer phase, as previously discussed, employers would need to ensure that a written employment contract is signed with employees within 30 days from the day employees start working at the new WFOE, and that capital would be injected in time to pay for the WFOE's expenses, in particular the salaries of the employees. Otherwise, investors would be exposed to potential employment-related legal risks. Lastly, with respect to the RO closure process, depending on how many problems you have with the tax clearance, the process could go on forever. We have seen cases in which it takes more than 2 years to close the RO. In the meantime, accounting and tax compliance activities may still need to be continued, causing additional costs to maintain the RO during the closure process. Additionally, any hidden tax liabilities being identified during the tax clearance process will need to be settled before the RO closure. Sometimes these tax liabilities are surprisingly large if investors do not carry out a proper tax review and try to remedy the situation beforehand. Finally, as the RO needs to maintain an address and lease to complete annual compliance, therefore, if the RO closure continue into the new year, investor will need to renew the lease agreement, thereby incurring additional costs for the RO closure.
Thank you, Isabelle, for giving us so many valuable information today. I believe anyone who's listening to this podcast should have deeper understanding about how to convert from RO to WFOE. Thanks again for coming, Isabelle.
No problem. Thanks for having me here.